Assalamualaikum warahmatullahi wabarakatuh. Our group will present on the effect of COVID-19 on Malaysia's banking sector. These are the group members for Group 1, which are DINE AIMAN, AZIMMUSTAQIM, DAYANG FATIHAH, Tengku MADHIHAH, and also SURAYA. My name is Tengku MADHIHAH binti Tengku MAHADI, and I will start on the introduction. What is banking sector? The banking sector is an industry that holds financial assets for others and invests those financial assets to create more wealth. Every country have their own banking industry in order to manage and plan their finance wisely. Financing firms, commercial banks, merchant banks, and money brokers are part of the banking sector. Next, Bank Negara Malaysia, or also known as BNM. BNM is a government organization. It is established on 26 January 1959 and regulated by the Central Bank of Malaysia Act 2009. The mission of BNM is to foster monetary and financial stability in Malaysia and also to provide a conducive environment for sustainable growth of the Malaysian economy. In late 2019, COVID-19 virus was first discovered in Wuhan, China, and spread all around the world and affected so many parties and sectors. This includes the banking sector. This paper will explain the effect of COVID-19 on the banking sector, specifically in Malaysia. There was a research done on the aviation sector and it is well explained on that topic. According to Zaki 2021, Malaysia's economy and the aviation sector in particular have been in a huge problem and the country has been pushed into uncertainty. The research paper mainly focused on the aviation sector. There is a motivation to do a research on another sector, which is the banking sector. Thus, this paper will explain more on the effect of COVID-19 in Malaysia, specifically on the banking sectors from the view on credit risk, liquidity, and investment. This paper also explains on how to encounter those effects. Next, I will continue on the literature review. Based on the previous research by Abu Bakar and Rosby 2021 stated that COVID-19 has a negative impact on the banking and finance industry economic situation. Wu and Olsen 2020 also stated that long-term, short-term, and systematic risks are all parts of the pandemic's result on the banking sector. This means that the effect from the pandemic will result in three types of risks on the banking sector. Moreover, Financial Stability Board 2020 mentioned that the financial system is still being strained by the ongoing uncertainty regarding the scope and length of the pandemic's economic impact. Next, Jero and Turnbull 2000 stated that the inability to differentiate between market and credit risk has an impact on the calculation of economic capital, which is important for regulators. The importance of bank liquidity as well as its consequences on banks has been emphasized by previous academic scholars. Analysis for bank liquidity focus on three main areas, which are maintaining liquid assets to aid in short-term financing runs, issuing stable deposit that may not run, and holding significant levels of equity financing to indicate long-term solvency and thus reduce the possibility runs. This research was done by Tyrol 2011. Next, Hariri 2020 states that usually investors make decisions based on irrelevant facts and statistics. For example, investors should buy in stocks that have had a significant drop after a period of continued rise in the recent past.
Next, I will continue with the challenges faced by the Malaysia's banking sector. As you can see, banking sector also faced various of challenges since the beginning of the COVID-19 pandemic, and it has stirred up the bank's short and long-term plans. The movement control order, which is known as MCO, was announced by the Prime Minister of Malaysia on 16 March 2020, is the biggest challenge faced by the banking sector. the orders to shut down all the business for a while and everyone's need to stay at home, unfortunately, leave a big impact on sectors, for instance, the tourism industry, which is interconnected with the banking sector. This can be proved by the Adventure Travel Trade Association, ATA. We mentioned that companies throughout the tourism industry are struggling since the revenue declined rapidly, but the expenditures still need to be paid. Other than that, services industry like the airline industry, they are also not exempted from encountering the negative outcome of the pandemic. It can be from the World Tourism Organization estimated that this industry around the world will lose about 252 billion USD passenger revenue as a result of the current pandemic situation. As a result, the circumstances have pressured the industry to lay off a big number of workers. For example, Air Asia has retrenched 2,400 employees and is flying only 8% of its Malaysian routes, whereas Malaysia Airlines has left over 13,000 employees on unpaid leave. Malaysian Association of Hotels, also known as MAH, also claimed that only 70% of hotels are still operational with average of occupancy rate below 20%. This result in aviation to lost RM 13 billion in 2020, while hotels have lost RM 11.3 billion since 2020 without any clear signs of recovery. As you can see from the diagrams, it is a summarization of what happened to the tourism industry, airline industry like the Air Asia and tourism industry, especially on the hotels. So, because of the frivolous performances of the other industries, it results in deterioration of the financial performance of Malaysia non-financial corporates, which is known as NFC, in the first half of 2020. This happened because when other industries' revenue fell sharply or lower inbound passengers lowered reduced spending on non-essential service and the weak demand across most of the sectors, it will force the bank sectors to be concerned about the credit risk, liquidity issue, and funding problems, since the investors might have negative sentiments on the bank's performances. All of this happened due to the industries accumulate less revenue and need to terminate workers' contracts due to the inability to pay their workers' wages. The industries also will likely need additional time to repay their loan with the bank, and some sectors might go bankrupt. And the end of the day will put more implications on the bank. Some workers who are terminated will also increase the unemployment rate, which afterward drives them to withdraw all their savings and deposits and leave the banks with less liquidity, as well as increase the application for borrowing loans. In addition, when all these things happens to the bank, it will highly affect the performance of the banks and leave bad impact on the upcoming investors. All of these will be discussed further in the effects of the COVID-19 on the banking sectors later on.
Hi and Assalamualaikum. I am DINE AIMAN bin Muhammad FAKHARUDDIN with metric number 2017-609. So moving forward to the next part, the COVID-19 effects on the banking sector and how to encounter them. So generally, throughout our research and discussion, we have agreed to discuss three major effects on the banking sector due to the emergence of COVID-19, which are the effects on credit risk, liquidity, and investment. So let us begin with the first one, the effect on credit risk. To start the ball rolling, what are credit risks and why it is regarded as one of the biggest risks for banks? There are a few important definitions and concepts with regard to credit risk. Firstly, according to Bank Negara Malaysia (BNM), credit risk, which also includes counterparty credit risk, is the risk of a counterparty failing to perform its obligation, meaning to say it refers to the risk that a lender may not receive the owed principal and interest, which results in an interruption of cash flows and increased costs for collections. Secondly, credit risk also may refer to the risk that is associated with a loan given by a bank which will not be repaid partially or fully on time. Thirdly, credit risk is the loss that the banks encounters when the borrowers fail to honor the debt obligation by the given due date or on loan maturity and may cause bankruptcy if not appropriately managed. Before we dive into how credit risk issues affected the banking sector and what are the measurements undertaken by the authority to encounter it, let us have a look at the glimpse of firms' effects and conditions during the pandemic, because it is interconnected with how banks should respond later on. So, in the first half of 2020, it has been reported that the financial performance of the Malaysian non-financial corporates, NFCs, has declined due to the extensive lockdowns in Malaysia and other countries to control the spread of the virus. Overall, the debt servicing capacity of NFCs has weakened due to the significant impact of the pandemic. However, it remained above the prudent threshold, reflecting reasonably healthy initial financial conditions before the pandemic. Not only that, the number of firms with an interest coverage ratio that is used as an indicator to measure a company's ability to pay outstanding debt interest, which is less than 2 times, increased to 32.1% from the listed firm in June 2020 as compared to December 2019 with 28.1%. So generally, the higher the ICR, the better it is, although the ideal ratio may vary between industries. The increased numbers of firms with lower ICR tells us that many firms are struggling to cover the cost of debt's interest due to the low amount of profits available, simply because they need to cut the cost of production and whatnot, that can lead to greater chance that the companies will not be able to service their debts and subsequently putting them at bankruptcy. So, how the conditions pertaining to the firms that I have mentioned earlier give impacts to the banks. To start off this part, statistics from BNM reported that banks have a higher share of business loans with increased credit risk, in which 13.9% in the first half of 2021 versus 11.5% in 2019. So as businesses are struggling to survive in this pandemic, so there is a high possibility that they would not be able to repay their outstanding debt to the banks, indicating that the credit risk of banks getting higher. Due to the negative relationship between credit risk and bank profitability, so unfortunately for the banks, this will result in bad financial performance, because the higher the risk, the lower the profitability of the banks is. To encounter this high risk of situation, I would like to focus on the first measurement taken by the government and banks back then during the early implementations of lockdown. So it is where the government wants to provide immediate cash flow relief following the implementation of MCO. From April 2020, banks introduced an automatic 6-month deferments on all eligible loan or financing repayments for individuals and SMEs. This enabled banking institutions to deliver immediate relief on a large scale to individuals and SMEs through a very difficult period of financial pressure and low mobility. At the same time, banking institutions' operational resources were reallocated to focus on supporting corporates in need of assistance by restructuring and rescheduling, also known as R&R, their loans financing, even though these were not covered under the automatic deferment program. So other than that, temporary exemptions from credit reporting under the Central Credit Reference Information System, CCRIS, were also provided to alleviate concerns among borrowers that availing themselves of the relief measures that would affect their credit history and future access to credit. As results, over 95% of individuals and SME borrowers took advantage of this automatic repayment deferment when it was introduced. Up until 25 September 2020, 840,000 individual and SME borrowers have already started to resume the repayments in line with the improved economic conditions. This number is expected to increase further following the end of the automatic repayment deferment later on. So this initiative not only aid the businesses to recover their operations and help the economy to bounce back from the downturn, but also has guided the banking sector to reduce credit risk as the borrowers start to repay their outstanding principal and interest, that as a result, the credit risk getting smaller and thus preserve the profitability of banks.
Hi, my name is AZIMMUSTAQIM, and for the next part, I will be talking about liquidity. So, what is liquidity? Liquidity is a bank's or firm's ability to meet its cash demands of its policy and contracts that it holds with minimum or no loss. And usually, liquidity refers to when the cash is needed in a short-term basis. Alright, so to better accommodate banks or financial institutions' liquidity, the central bank or Bank Negara Malaysia has outlined a few policies that financial institutions needs to be met. The first one is the overnight policy rate or OPR. This is actually in the monetary policy components, which is called reserve requirement, but in Malaysia it is called overnight policy rate. So it is the required amount of cash that every banks need to have deposited in the central bank or in their vaults in line with the deposits from customers. And the second one is NSFR, which is net stable funding ratio, and LCR, which is liquidity coverage ratio. The NSFR is a minimum standard that requires banking institutions to maintain a stable funding to support their assets and off-balance sheet activities, while LCR encourages the short-term resilience in 30 days of banking institution liquidity risk profile. The NSFR aims to reduce funding risk over a horizon time of 1 year. So both of these policies complement each other, so that banks can achieve and preserve their liquidity. Okay, so during the COVID-19 pandemic, there are two main factors that caused the liquidity crunches in the banking institution of Malaysia. The first one is low interest rate. As you all know, when there is low interest rate, that it is very beneficial to borrowers, as they are very beneficial from it. However, it is not very beneficial for banks, as it discourages savers from saving money in the bank. So when savers don't want or is not appealing to save in the bank loses their one of the main source of income, which and they cannot lend out more money to make any income from the interest received. And the second causes of liquidity crunches in Malaysian banking is the 6-month moratorium. 6-month moratorium announced by the central government, the central bank. Okay, so on the 7th of July 2021, the central bank announced a 6-month moratorium. It means that every loan or anything like that could be hold off for 6 months, and the citizens of Malaysia can opt to not pay their loans during a duration of 6 months if they are eligible for it. So banks are supposed to receive these loans during the amount that is agreed upon before the pandemic starts. However, due to the pandemic, due to this moratorium and the pandemic, customers or the borrowers would opt to choose not to pay the loan and use the 6-month moratorium. And it also applies to the bank that they will lose the money that they lend out, and it will delay the money that they will be receiving. Hence, banks run out of cash to pay for costs, and it will be increase the risk to credit risk, as it holds off the customers supposed to pay at the time being. Last but not least is how that the Malaysian government or Malaysian Central Bank overcome these liquidity issues in Malaysia. So the first move that has been made is to reduce or to accommodate banks with the OPR, LCR, and NSFR. So as you can see from the Bank Negara website, the OPR has dropped from 3% to 1.75% during the pandemic, which means that banks need to have less amount of cash deposit in their vault, and this the surplus amount of cash could be used to be lended out and to be used for their daily activities. And for the NSFR and LCR is that banks are to be operate below the minimum requirement of LCR, which is 100%, and the central bank lowers the NSFR to 80%. And the second way that the central bank has been using to accommodate these liquidity crunches is by open market operations. As mentioned in the banker website, the central bank will be using open market operations as part of its monetary policy to purchase government securities, foreign exchange swaps, reverse repos, and the standing facility to facilitate the daily ringgit liquidity.
Assalamualaikum, my name is Suraya and I will be presenting about COVID-19 effects on the investment activity. So according to Abu Bakar and Rosby, investment activity is one of the main activities in the banking sector whereby deposit made by the people will be used to generate profit. In Malaysia, the performance of investment activity can be analysed through banks' investment portfolio in Malaysia's stock exchange market, Bursa Malaysia. According to the study of COVID-19 effect on banking and finance industry conducted by Abu Bakar and Rosby, it was found that the selected commercial banks, which are Malayan Banking Berhad and CIMB Bank Berhad share price were declining as the pandemic hit. The declining share price of these two banks may cause negative sentiments from investor side, which may then lead to potential funding problems. Another study conducted by Chia mentioned that there is evidence from numerous empirical studies proving that Malaysian stock returns are affected by investors' sentiment. Looking at a broader perspective of investment activity in Malaysia, the financial account imbalance of payment shows a higher net outflow due to higher outflow in portfolio investment account and other investment account. Higher net outflow in the portfolio investment account is due to high resident investment abroad by domestic institutional investors in the equity and debt securities market to diversify risk exposure and increase return. Meanwhile, the non-resident investors were liquidating the domestic equity securities due to uncertainties in Malaysia's equity and debt market. The other investment account recorded high net outflow due to net repayment of interbank borrowings and withdrawals of deposit placements from the banking sector. So, to counter the investors' negative sentiment, Malaysian government has came up with several measures. Here we will discuss three of them. First, National Investment Aspiration. This aspiration is a forward-looking national policy aimed at attracting the right investments, building innovation capacity, and increasing both productivity and growth. Following this aspiration, Bank Negara Malaysia had established High Tech Facility National Investment Aspiration (HTFNIA) to provide financing support for high technology and innovative small and medium enterprises (SME) for them to remain competitive in the market. Secondly, under the National Economic Recovery Plan Penjana, Several tax incentives were introduced. One of them is a 10 to 15 years tax redemption for new foreign direct investment in the manufacturing sector with capital investment of 300 million ringgit or more. This incentive will attract foreign investors to consider Malaysia as one of the places for them to do their business. Lastly, Malaysia Digital Economic Blueprint was introduced to execute the My Digital initiative. This blueprint is aimed to transform Malaysia into a digitally driven, high-income nation and a regional leader in the digital economy. This blueprint is targeted to improve the quality of life of Malaysian people, to provide greater opportunities for SMEs owners to locally and globally expand their business, and to provide integrated end-to-end online government services. This blueprint will enable various government projects to begin to establish a safe, functional and efficient digital economy in Malaysia, hence it will attract investors to come to Malaysia.
Therefore, it can be concluded that through the COVID-19, Malaysia's banking sector has to face several challenges and was heavily affected during the pandemic. All of the challenges have put banks in tight position as banks are exposed to the high rate of credit risk, urgency to maintain liquidation of the banks, and to display and maintain great performances to attract investors, especially for the post-pandemic era. When there are higher chances of people who are not able to repay their debts, there are also higher chances of people who are going to apply for loans as well as massive withdrawal of savings and deposits, which later on will disrupt the liquidity of the banks and cause turmoil in the bank's cash flows. Banks also have to make sure the activity in the banking sector remains protected and investor sentiment have to be on the bright side. For that, Malaysia's economy has to appear strong, and with initiatives taken by the Malaysian government and the central bank, the economy will slowly grow in the intended direction. For the future research transition, it can provide statistical data in depth based on the initiative taken by the government in order to present the effectiveness of the methods taken. This is to ensure that banks are in a safe position as the influence of the bank has on the prosperity of the economic system is essential. Other than that, future research can also focus on how banks have to adapt their operating models to drive efficiency and resilience. They cannot afford to stay in the same way of providing services to the customers and to guarantee that they will not have to face the severe outcome of the pandemic.